Hello and welcome back to Express videos for ACCA paper P2. In this current video we will talk about financial instruments, and please remember to download our Express notes from our website www.theexpgroup.com. Currently, financial instruments are governed by four standards. IAS 32, which deals with classification, IAS 39, which deals with measurement, and IFRS 9, which currently is overlapping with IAS 39. The only missing bit in IFRS 9 being hedge accounting, and IFRS 7, which only deals with disclosures. The way to study for the exam is to know the following things with respect to financial instruments: their classification, what is a financial asset, what's a financial liability, how do we value it, how then we subsequent measure them, either at fair value or amortized cost, and you need to know the two accounting treatments, and how can we report the gains or losses on the financial instruments, which is either in your profit and loss account or either in other comprehensive income. And then we'll talk about hedge accounting and how this will actually differ if we are talking about a fair value hedge or a cash flow hedge. Firstly, let's talk about classifications of financial instruments. Firstly, a financial instrument is just a contract. Based on this contract, one part will have an asset and the other entity will have a liability. Dealing with financial liabilities, examples would be trade payables, debentures, loans, redeemable preference shares, and those will initially be recognized at fair value, and subsequent measurement will be either fair value, especially for derivatives and liabilities held for trading, or amortized cost. Gains and losses will be reported to profit and loss. With financial assets, those being trade receivable options, investment in equity shares, cash, the initial recognition will still be at fair value and will include the transaction costs for all assets except the one which are kept at fair value to profit and loss and derivatives. How to account for it is either the fair value, which will be reported in profit and loss or other comprehensive income, or amortized cost less any impairments to date. And the gains or loss on the fair value will either be reported in P&L or other comprehensive income. Key workings and methods to remember in the exam. First of all, with respect to recognition and derecognition of financial instrument, the criteria is slightly different than what we know from the conceptual framework, in the sense that we want to recognize them as soon as possible for as long as possible. So when the entity becomes a party into the contract, this is actually when the financial instrument will be reflected in the financial statements, not when the actual control is obtained. They will be derecognized when the company is virtually risk-free, meaning the risk of the financial instruments either have been expired or they have been sold, transferred to another party. Fair value accounting. Fair value accounting actually means revaluing the asset or the liability at market value every time. So if we bought, let's say, 10,000 shares in another company for $4, and by the year end these shares actually reach a value of 7, then we make a gain. That gain is actually going to be reported in the profit and loss account. The valuation, the fair value if you want, will actually depend on whether or not the instrument is traded. So therefore, if it's traded, we will take the best achievable market value, not deducted the expected transaction cost. If the instrument is not traded, we will use some valuation techniques using discounted cash flows. Or exceptionally, if discounted cash flows cannot be used, we will actually value them at historical cost, the amount of money that we actually pay for it. Amortized cost. Amortized cost can be applied to debt instruments if and only if two tests have been passed. That is the business model test and the contractual cash flows characteristics test. The business model test is actually established within the company practices. So we have to look whether or not the company will actually hold the instrument until maturity in order to enjoy the cash flows which derive from this instrument. If not, and the company basically decides to sell the instrument before the maturity, then this test is not passed. And therefore the instrument cannot be accounted for at amortized cost. Contractual cash flow characteristics test actually determines whether the contractual terms of the financial asset will actually give rise to cash flows on specified dates that are solely consisting of the principal and interest based upon the principal amount outstanding. If this is not the case, then this test is failed, and therefore the financial asset cannot be measured at amortized cost. And this, for instance, will be the case of a convertible bond, which besides interest and principal, it has this option to convert the bond into the equity, and therefore the contractual cash flow characteristics test is failed, and it must be accounted most likely at fair value to profit and loss. In summary, for a debt instrument to be measured at amortized cost, it will require that the asset is held within the business model with the objective to hold it and actually collect the contractual cash flows. And these contractual cash flows actually consist solely of payments of principal, interest outstanding on the principal. So if you look at an example, we have a company Cordelia, which on 1st of January 2001 issued a bond with a nominal value of 200,000, a coupon rate, meaning cash paid, of 4% on the nominal value. The bond is due for redemption on 31st of December 2008 at 200,000 plus the coupon payable on that date, meaning the interest for the year. In order to account for it at amortized cost, what we need is not the nominal value, but we will need what is the internal rate of return. In order to calculate this, we will look at the stream of cash flows which actually derive from this instrument, meaning a payment of interest of 8,000 per annum and the repayment of the principal plus the interest for year 5. Most likely in the exam, this rate will be given. How amortized cost actually is applying the same technique that we use, for instance, for leases. We start with an opening balance of a liability. We charge into the P&L. This one will be our finance cost, which is charged on the outstanding balance, less the coupon paid. This is the interest payable each and every year. Will slowly increase our liability. So at the end of year 5, we will actually reach the 200,000, which becomes payable to the holder of the bonds. So in other words, the instrument was actually amortized from an initial value to the redemption value of 200,000. How we will do this? If it's a liability, like in this case, we will charge finance cost in P&L, or if you talk about an asset which is going to be kept at amortized cost, what we will charge is financing income. Reclassifications. What happens if partway into the year we actually reclassify the asset due to changes in the business model? So we will no longer hold the instrument until maturity to enjoy the cash flows implicit by that instrument, and therefore we sell it. In this case, if reclassification happens, it should be applied as if it took place on the first date of the accounting period. So we actually change the accounting policy from amortized cost to fair value starting at the beginning of the year. Impairments. Remember, assets cannot be carried in the statement of financial position at an amount which is higher than the recoverable amount. Any asset that we actually keep at fair value, these are automatically impaired. All the assets which are reflected in the statement of financial position at amortized cost, this must be tested for impairments if there are impairments indicator. The amount of the recoverable amount actually will be calculated basically by looking at the new cash flows which are derived from the asset, and we will have to discount them back using the original rate of interest, because otherwise if you will use the new market rate or the new interest rate, we will actually be double counting the same risk. The difference between the two, what we have as value for the instrument in the statement of financial position less the recoverable amount calculated by the revised cash flows discounted at the original discount rate, it will be the impairment loss which will be booked for the year directly in the P&L. Let's take a look at hedge accounting. Hedge accounting is tested occasionally in your exam, either as part of question 1 or in section B of the exam. Key workings and methods actually to remember in the exam. Hedging is just protection. I want to protect against something. Okay, that something is called a hedged item. So the thing that I actually worry that will change value, which can be foreign currency investment, foreign currency payable, or variable interest rate on loans, which actually will result in higher than expected cash flows. Forecast future major purchase of foreign currency, which can become unaffordable due to the exchange rate movements. So, in order to protect the hedge item, what the entity does, it actually enters into a financial instrument, most of the times signs up a derivative, in order to counterweight the movement in the hedge item. This derivative or financial instrument, which is actually signed by the entity, is called hedging instrument, which is actually helping me to protect my hedged item. There are different accounting treatments if we are talking about a fair value hedge or a cash flow hedge. The easiest way to remember the difference between the two is the following. A fair value hedge, in this case, the hedge instrument was taken in order to protect something or the value of something which is already in the statement of financial position, a receivable, a payable, an inventory. So, for instance, we have taken out a foreign currency loan to protect against a foreign exchange in value of a foreign currency receivable that is being shown currently in the statement of financial position. A cash flow hedge, this is everything else. If you want a very short definition, that is not a fair value hedge. So the hedged item which we are trying to protect, it's not yet in our statement of financial position. So for instance, let's assume you are a jewelry and we want to buy diamonds in the future, okay? And you are worried that, you know, the diamond prices will go up, and therefore you want to ensure that you can afford to buy them in the future, and therefore what you do, you can buy a foreign currency forward contract, for instance, which is a derivative. Accounting for hedges is not really that complicated. If we are talking about a fair value hedge, remember both the hedge item and the hedge instrument are in the statement of financial position. One will go up in value, making a gain, the other one will make a loss. Ideally, they will net each other off, but both effects of the gain and of the loss will be reflected directly in P&L. With a cash flow hedge, This is a little bit more complicated. Currently, I have the financial instrument in my statement of financial position. What I'm missing is the hedge item, which is, the future purchase of diamonds in our example. And in this case, we will actually show the gain or loss on the hedging instrument in other comprehensive income until the hedge transaction, the acquisition of the diamonds, will actually take place.